we are just discussing about retirement plan for elderly ones, chapter 17. Chapter 7. Yeah, we're discussing about health insurance plan for seniors. So this particular chapter concerns everybody, me and you, because one day all of we will become seniors. If we are not seniors now, definitely one day we'll become seniors. So this chapter is very, very important for everybody. And not only important for your exam, it's only important for you to know some of the facts that we discussed yesterday. And again, the facts that you will going to discuss with your clients when you finally start off the business. So it wasn't much, but again, we're gonna try to touch all that we have discussed yesterday as we go along. So you're welcome. All right. So as we wait others to join, I know most people will join. So yesterday we were about 17 of us in the morning. So let's go ahead. Let's start from where we stopped and hope we are going to finish it today. We're going to finish it today and oh sorry. I choose the wrong one. We have talked about benefit period, pool of money concept, optional long-term care provisions. I think we have discussed this. Did we discuss this yesterday? I hope so. Yeah. All right. We were on non-for-future benefit options yesterday. I think that's exactly where we stopped, or whether we have finished them. So we are talking about health insurance now. It's not about life insurance. But most of the things we see here is also applicable in life insurance. So the health insurance aspect of it is more often related to life insurance. So we're now talking about non-for-future benefit option. It says some states also require long-term care. Long-term care, you can have it as a rider, and also you can have it as a single policy. So if you do not have it, get it as rider, you can also get it as a single policy. In your main policy, life insurance, long-term rider is one of the optional riders you can choose. You have critical rider, you have a chronic rider, you have terminal rider, illness rider. So, and also you have long-term care rider. Within these four riders, three of them, most of the insurance company give you three of them as one of the things they attach to the policy. So you can decide on four of them which one you want to choose. Despite you getting it as a rider in your policy, you can also buy a long-term care policy as a single policy. So if you decide to buy it as a single policy, then there's element of it attached in terms of your premium, what you are paying. And in case if you decide to say you're no longer interested in the policy, there's element of return, element of benefits you're going to return out of, or you're going to get out of it in terms of your premium. So those element now is what we're going to discuss. Are they going to come in form of what? That's what I'm going to discuss. So in some states, long-term care insurers offer non-for-future benefit as part of the policy, of which we have discussed, which allow the insured to receive some value from the plan if the policy lapses due to non-payment. Remember, we have return of premium rider in term life insurance. we have in cash value insurance, we also have element of non-forfeiture, which comes from your premium. So here in a long-term care policy, LTC policy, single policy, which if you decide to buy it, you still have this non-forfeiture benefits attached to it. So this option is available in one of three different forms. If the insured ceases to pay premium after a specified number of years, you bought the policy, you are using it you bought the policy at the point you say, oh, I can no longer continue with it. If you say you can no longer continue with it, then there's these three options of non-forfeiture benefit option that is available for you. You can use to get the portion they are going to give you back. You can use to get the portions in which they want to give you back. And what is that portion? The premium you paid. A portion of the premium you paid will be given back to you. Then one of them you can use to get it back is what? You can do reduced paid up benefits. Reduced paid up benefits. Of course, the insurance company would provide the insured with a reduced daily benefit amount for the original period. You decide to talk the period of the long-term care benefit period, they can spread it on the original benefit period, which you have signed during your contract. 2, shorten the benefit period. They can decide not to spread it along the benefit period, which is the reduced paid up benefit. They can use the shortened benefit period, which means instead of following the original benefit period scheduled during the contract, they can shorten the benefit period. So that's shortened benefit period. Then the last one is return of premium. Of course, the insurance company will refund a specific amount to the insured, the most expensive form. Of course, in some states, this option is prohibited from being part of non-forfeiture provisions. So return of premium is not allowed in most of states, although he did not name the states, but from Excess Solution, because we are reading from Excess Solution, they are one of the best people in terms of training. We are getting this knowledge from them. So return of premium are not used in most of the states. Most states see it as being prohibited. They use reduced paid up benefit and shortened benefit period. So the non-forfeiture provision can be a relatively expensive option. At the same time, this option can be important given the cost of long-term care insurance. Long-term care insurance is not that expensive. In fact, it's one of the things it left to me to recommend. I recommend it to anybody who is aspiring one day to get old. To retire, you need it. If you have a good one, you may have somebody to take care of you when you grow old. If you have it, instead of going to facilities, you can be at your home while you get money to pay them. So that's long-term care. So contingent non-forfeiture benefits. Remember, in beneficiary, we have the primary, secondary beneficiary, call it contingent beneficiary, then the tertiary beneficiary. I hope everybody remember that. So we have contingent non-forfeiture benefits. It's built in future in all tax qualified long-term care policies. What does this provision give us? It triggers when the insurer enacts a significant premium increase as defined in the policy. When triggered, what happened? The policy owner may choose to exercise the reduced coverage or paid up non-forfeiture option. The benefit is a form of consumer protection. It prevents an individual from what? Having to give up coverage because of unaffordable premium. In case if anybody desires that, why do non-forfeiture come in? It come in when you cannot be able to pay your premium. You forfeit when you allow your policies to terminate because you cannot be able to pay your premium. What you are getting back is where non-forfeiture comes to play. Remember, in term life insurance, it's there. If you actually have it, return of premium rider, what happened? You can get your money back if you terminate your policy. In permanent or whole life insurance is also there. The part of the premium that goes to the cash value is not forfeiture. You can still get part of it back if your policy terminates. You decide to terminate your policy. Inflation riders. The impact of inflation, of course, in everything you do, always consider inflation is a bigger part of things to consider in today's economy, because what you buy, if you go to where you buy something last year, let's assume you bought a fridge last year, that same type of fridge, if you go back today to buy it, you see that it may not be the same price. So whatever you are doing should have make sure that you consider inflation. So we have inflation riders that can be attached to long-term care. Inflation, if you have inflation rider, remember any rider you choose in life insurance policy, remember there's a premium added to it. So you cannot get a rider without premium attached to it. So if you choose to want inflation rider, what will happen? Definitely a premium will be attached to it. So the impact of inflation on long-term care cost is significant. Of course, at a 5% inflation rate, the cost of care will double in approximately 15 years. That is the truth. So the typical long-term care insurance buyer is in their 50s or early 60s, has a life expectancy of 20 years or more. So this means inflation is an important consideration. For this reason, virtually all states require insurer to offer inflation protection, at least to applicants under an age of certain age, such as 76. Protection may be offered in the form of guaranteed insurability option or an automatic increase option. So inflation, they consider inflation and long-term care, because judging from what is going on today, you see that there's always impact of inflation in everything, particularly in the economy. In fact, in everything we do, there's impact of inflation. So based on that, long-term care insurers now consider adding a protection to long-term care in terms of impact of inflation. So doing that, they now give you two ways you can protect your policy from impact of inflation. One of the ways is guaranteed insurability option or automatic increase option. So these are the two ways to protect inflation impact in your long-term care policy. So I think if I'm you, I will just write these two down. They look so common, but they may be important for you to know in your exam. Guaranteed insurability option and automatic increase option. The two ways to prevent the impact of inflation in your long-term care policy. Is applicable to what? Only long-term care policy, please. So the guaranteed insurability option rider and the automatic inflation rider. So what does guarantee or insurability option rider? What does it do? It's a form of inflation protection that allows the insured to purchase additional coverage at future intervals based on assumed rate of inflation at their attained age. So if you have this rider, you are able to purchase additional coverage. Remember what we said from what we discussed. Remember, when you have a policy, you can do what? You can reduce the first amount at any time you want, but you cannot increase it at any time you want. Remember. So, but if you have this guaranteed insurability option rider in your long-term care policy, only in your long-term care policy, LTC, if you have it, it guarantees you the opportunity to do what? Increase your policy at any age, at the age you want. If you have what guaranteed insurability option rider, you can increase it. On long-term care policy, we're not talking about other policies on long-term care. The rider would resemble a similar disability and life insurance policy option, except this increase in long-term care benefits based on inflation. You can only increase based on inflation. it provides an increase in benefit generally equal to 5% increase, without requiring the insured to have what? To prove insurability. So means you can increase your what? Your first amount by without them asking you for a proof of insurability if you have guaranteed insurability option rider in your long-term care. So that is what actually it does. Now, another option is what? Automatic inflation rider. You can also have this in your long-term care if you so desire. It's a rider. It offers some form of inflation protection to a long-term care policy owner. What does the automatic inflation rider does? It means this one by increasing the stated daily benefit of long-term care insurer policy. So if you have automatic inflation rider, what does it do? The benefit, when you begin to get your benefit from long-term care, it increases it. However, you have to have this as a rider in your policy before the increase can be effected, and depending on the inflation rate in that year. So these are the two ways you can increase your, one, increase your first amount, and two, increase your benefit. So using these riders, if you have it in your policy, it works for you. The policy we will have is long-term care policy, no other policy place. So I think, so let's look at marketing, application, and underwriting. Always, underwriting is a very important issue in life insurance, whether life insurance or health insurance. Underwriters are a very important aspect of insurance policy. Remember why the underwriters come into being. Why are they in insurance business? Anybody remember why underwriters are in insurance business? Do anybody remember? Why do we have underwriters? Why do those underwriters introduce in insurance business? Anybody remember?
To help make sure that the right people are the one applying for insurance. Like not just to give anybody insurance, so they vet all the right.
Yeah, of course, but there is one audit.
Yeah, prevent adverse
Adverse reaction.
adverse reaction.
Adverse selection.
Selection.
To prevent, yeah, Hillary
Prevent
got it right, but like, you know it, but you know what it means. But the right word is what? Adverse selection. Why the underwriters were introduced to what? Prevent adverse selection. Adverse selection is the situation where people who are at higher risk always go for insurance. You know that most times people will be almost terminally ill, they will go for insurance. That's how it has been. And insurance people has been what? Insurance company has been getting lost, paying benefit always. So as the thing continues to go, insurance companies see themselves as being getting their money, their business almost going down. What they do is to now think about what they will do to stop that. So they now introduce underwriters. Remember, in insurance, the agent is the agent who is also called the producer is the first person that starts underwriting business. Underwriting business starts from the feed underwriter. Who is the feed underwriter? The agent or the producer. That is you. When you get your license, you become a feed underwriter, you become an agent. I think Kevin is here. Kevin got his license yesterday. Is he still here? Oh, it is out. So I saw him logged in. Probably he want to say hi to everybody. So Kevin wrote his exam yesterday, and he passed. So he has his license now. It's out. All right. So that's what it is. If you, as an agent or producer, you are the first person to speak with the client. You are the first person to speak with the customer. You are the underwriter. All the information you gather together, you put them in form of application with the client. You guys now send it to the underwriter who is in the office. The underwriter will now go through it, either to approve or to deny the policy. That is basically what you do as an agent or a producer or a feed underwriter. You gather information from the client in form of application. You package them and send to the underwriter in the office. Then remember, you are the feed underwriter in the field. Then the underwriter in the office. Two of you are working for the insurance company. So basically, you represent the insurance company in the field. And the one in the office have to do something with you because you gave him information through the agent that he is using to work, to approve or to deny the client, the policy. If the client is up to the standard to be approved, the underwriter will approve. If it is a standard to deny, the underwriter will deny it. So that's how it works in insurance business. So adverse selection is the reason why underwriting business was introduced in insurance business. So let's look at the marketing, application, and underwriting. Marketing, application, and underwriting in what? Long-term care. So long-term care is marketed to adults. So me and you, of course, we don't have anybody below 20 years here or 30 years. All of us are adults. All of us, some of us are even older. So this is very important for us. Marketing, application, and underwriting of long-term care. See, long-term care is marketed to adults. Children, most children, somebody can buy a long-term care for his baby, for his child. Yes. Because remember, the earlier the better. The earlier the better, and the less price it is. When you begin to grow old, you see that buy the policy, it will be pricey because of your age. Age is a big factor in buying policy. That's the more reason why at any day you wake up is the best day for you to have your policy. Because tomorrow you add 1 day to your age. So if somebody is 50 now, you're waiting until, let me wait by next year, I'll get the money to buy it. It does not work that way. Insurance is that day you wake up, do it that day, because tomorrow may or may not be there. And again, tomorrow, if tomorrow is there, then tomorrow you're adding 1 day to your age. So you are indirectly increasing your premium. So there is no minimum age requirement other than the requirement of reaching the age of 18. You see it? So from age of 18, you can buy a long-term care. That's what I say. There is no minimum age requirement other than the requirement of reaching the age of 18. So from age of 18, you can get your long-term care. Unlike other policies from if a child is born that day, first day on 8, that child can have policy. Or sometimes they say 14 days on 8. But first day on 8, you can get a policy. Now, for you to have a long-term care, you have to be up to 18 years. That's what I say here. For you to get a long-term care, you have to reach at least age of 18 years. That is a minimum age for you to have long-term care. You can see that long-term care policy have its own words, straight requirements. The requirement is that you must be at least 18 years of age. So, which is the age of legal majority? Remember, the age of maturity or legal majority in Texas is 18 years. So find out from your age, from your state, what is your legal majority, age of maturity or age of legal majority. Find out. Each state have their own age of legal majority or age of maturity. Texas, if you are in Texas, Texas is 18 years. Now, insurers generally stop issuing standalone policy after age of 79. Remember, long-term care, you can have it long-term care as a rider. You can also have it as a straight alone policy. They can issue it to you if you're at least 18 years of age. They stop issuing to you if you're 79 years of age. So from 79 years of age, you can no longer get a long-term care policy. Please, everyone should do that. So although hybrid contracts such as long-term care annuities may be issued to those in their 80s, like long-term care annuities, that one becomes annuity. It's no longer insurance. So long-term care insurance has a specific age of 18 and they stop issuing it at age of 79. Yeah. The trend is recorded. The training is recorded, please. So minimum age of 18 years and maximum age of 79. They will not issue you long-term care if you are age of 79. They stop issuing at age of 79. You can have annuity at 80s, from 80s above, you can, but long-term care from 79 no more. And they cannot give it to you when you are 5 years or 6 years or 7 years. You must be 18 years before they can issue you long-term care. So these are the things we have to have in mind. Now, insurers that market long-term care must establish marketing procedure to address the following concern. Most people, all of us are doubting Thomases. Most times, what is holding our community today is that because most of us, we are too much educated that sometimes the principal thing that we're supposed to do, we don't do them because we base on the external information we have. We cannot even try to find out what is that's the real truth. We can get information from from YouTube, from TikTok, from all those. Any information we get from there, some of us get it to be a correct and formidable information. More time for us to find out the rating. We don't do that. So the marketing of long-term care must address the following. It must ensure that any policy comparison made by agent or other producer will be fair and adequate. They must avoid selling excessive insurance. Excessive insurance is that when you buy more than you can be able to afford. Of course, insurance policy is like you go into the store to buy something. When you go into the store to buy something, you're not going to buy. If you go to Walmart, you're not going to carry all the truck to go and pack everything in the Walmart. No. You go and buy what you need and buy only the things you can afford. I think maybe some of you may have experienced, you go and buy something, you come to check out, you begin to pick those things you want and those things you don't want. Because you are trying to get the ones that you can afford. So here in marketing, in long-term care, you must make sure that the person can afford it. Do not buy excessive insurance. The marketer must also advise buyers that their long-term care policy may not cover all costs associated with long-term care. So there may be some costs that cannot be covered by long-term care. That is one of the things you have to tell your clients. So whenever insurer is replacing another long-term care policy, the insurer must waive any pre-existing condition limitation that exists in the replacement policy. They often consider pre-existing conditions, yes, because they do not want a situation that you go and buy long-term care. The next day, you already starting the benefit. Just like, why do they do that? Just like what the underwriters do to prevent adverse selection. They will not want adverse selection here too. They always want to prevent it. All right, so most of the same prohibited sales and marketing practices identified in relation to a sale of Medigap policies also apply to the sale of what? Long-term care insurance, high-pressure tactics, cold lead advertising, and twisting. Oftentimes, you see twisting in insurance business. Twisting. Who knows what is twisting? Who knows what is twisting? You may see that in the exam. What is twisting? What is twisting? Anybody knows? Can anybody help us? What is twisting? Sometimes you can see it in the exam, of course. All right. So anytime you see, just like, all right, let me ask this one again. What is commingling? Commingling. Anybody remember what is commingling?
Commingling is when you are adding the insurance premium with your own personal bank account.
Yeah, when you are mixing, sometimes they say when you are mixing, yeah, the premium the applicant give you with your own money. Mixing the premium with your own money is what is called commingling. You are right, though. So twisting is an illegal act in insurance business. It's very, very unethical practice. It's very unethical practice. What does it mean? Where you, you are an agent, you are a producer or field underwriter, where you misrepresent or incomplete comparison with or to, in any way to trick a policyholder to buy a new and similar one from different company. For instance, let's assume, let me use somebody as an example. All right, let's assume Sophia has have a policy, and Mary, I think Mary is here, and all right, Popola, let's assume Sophia has a policy, and Popola is an agent. Sophia is Popola's friend. Now, Popola, being an agent, want to sell policy to Sophia. Meanwhile, Sophia has long-term care. Popola now come, he want to tell Sophia, look, I know you have this, but she is trying to compare the one Sophia has with what she is selling. Is a misrepresentation in form of trying to misrepresent the facts by doing an incomplete comparison. Incomplete comparison to what? To trick Popola to buy what she has. So that's exactly what it is. So it's an incomplete comparison to trick a policyholder into dropping their current policy to buy the one they have. That's what we call twisting. Do anybody get it? Everybody get it?
Yes.
All right. So that's what's called twisting. So it's always there in twisting is always there in exam place. Not it's this twisting, see, commingling. These two things are always in the exam. And when you see it, if you don't know it, he look very strange. He look very, very strange if you don't know it. Commingling in particular, twisting, two of them. They are strange words that you should know. They're always there in exam. So premium and rating. How the rating comes from risk rating. So long-term care policy premium depends on several factors, including what? Age, health condition, benefit period, and level of care. Remember, what is the benefit period? Anybody remember the benefit period? What is the benefit period? Can anybody help us?
Yeah, benefit period, I think, is when they start getting when they start getting the benefit.
Mm-hmm. You are getting it, but you don't know how to put it. You forgot how to put it well. Any other person? Yes, go ahead.
Something like that.
Any other person to help? Benefit period, what is it? Remember, when you say it out, it don't get out from you again. It's on you. So just on your own word, you don't need to define it as it is. Define it on your own word. If you define it on your own word, when you see it in the exam, honestly, you're gonna get it correct. You don't try to cram the definition you see on the book. No, just know what it is. Know what it is. All these terms we are defining, just know what they are. If you see it in the exam, you'll get it correct. Because in the exam, they're not going to use the same word that you see in the paper. They're going to use another thing to define it, meaning the same thing, So, however, benefit period is the period in which you start from the time you start receiving your benefit till when it ends. So those periods, let's assume in the contract, after writing the contract, long-term care contract, you said anytime you start receiving the benefits, maybe when you are sick, because only benefit will trigger, receiving benefit will trigger due to illness. When you cannot, in long-term care, when you cannot be able to do 2 or 3 of the activities of the 6 activities of daily living, 2 to 3 out of the 6 activities of daily living. If you cannot be able to do 2 of them, what happened? Long-term care policy will what? Trigger on. You start receiving them. And what are those activities of daily living? When you cannot feed yourself, when you cannot toilet yourself, when you cannot transfer yourself, when you cannot take bath by yourself, when you are incontinent, that is, somebody don't know when he peep or when he poop. So all those, there are 6 of them. If you cannot be able to do them by yourself, 2 out of the 6 or 3 out of the 6, if you cannot be able to do it by yourself, what happened? Long-term care will now come into play. And if you check out, these things we mentioned now are what are the problems we have that can lead somebody to go to nursing home or to go to what? To go to facilities. So when somebody is sick and cannot be able to do those things, and you see that in your home, your children are not available to do them because they may be at their husband or with their wife, or they may be going to work. They cannot be able to do those things for you. Basically, that's what it is. More especially back in Africa, where most of us come from. Even if you cannot do it, neighbor can help. Of course, all of us know. Neighbor can help. But here, neighbors will not help. Children too, they will be there. They cannot help because they go to work. So that is when the long-term care is very necessary. And that's when the children will now be considering where are they going to place their parents to be able to receive all those attention. And the only place they can do that is going to facilities such as nursing homes or what they call it, nursing homes and what, which other one? There's one other one, facilities. They can take these to send the person to. So, but if you have a long-term care, you can decide to be at home. They can bring somebody into your home to take care of you.
Assisted living home.
Assisted living home, yes. That's what I was thinking, assisted living home. So, but if you have a long-term care, you don't need to go to anywhere. You can be in your house. The only thing they need to do is to find somebody who will come to your house. Of course, you have the money to pay the person. Because the now benefit period now is from the time you start paying the person till when the benefit you are getting from, all right, let me say when the money finishes in a long-term policy. Most long-term policies spread up to 20 years. And believe you me, from the time somebody retired or from the time you start to need the care of long-term care, it's difficult to even stay 20 years from that time till when the person will join the ancestors. That is the truth. It's hard to see somebody who's sick for 20 years. So what this thing is guiding you is to guide you from unnecessary suffering and dying untimely as the case may be. Because sometimes when you go to those facilities, it's just like somebody going there waiting for his death. But imagine the person being in his or her own home, you'll be comfortable. Even death, all of us, of course, one day we die, but the death will now come not as a pain, but as a normal thing that comes. So the benefit period is the period from the time you start receiving your period till when the period ends. That is the benefit period. The time you start receiving the benefit till when the benefit ends. That period, if you start receiving today and it ends next tomorrow, today to next tomorrow is the benefit period. So please just know that. So the younger the insured, the lower the premium. Of course, we all know that the younger the insured, the lower the premium. If you decide to buy a long-term care policy for your child who is 18 years, definitely gonna get the premium will be very low. And you have maximum first amount. Yeah. If you a child of 18 years, you buy long-term care policy for that child, maybe $1 million long-term care policy. Probably maybe paying $100. But go and buy $1 million policy, long-term care policy for a person, somebody who is 80 years old. I mean, 70 years old, because long-term care, remember, is 79. From 79, they can't issue you long-term care. If you go buy $1 million for a person who is 70 years old and somebody who is 18 years old, they're not going to be the same. The person who is older will pay more premium. So the younger the insured, the lower the premium. So for individuals of the same age, a shorter benefit period or lower level of care results in low policy premium. Shorter benefit period. So if I'm buying long-term care and Miss Nancy is buying long-term care, and two of us I decide that I will buy, my own will last for 5 years, and Nancy say her own will last for 10 years. Then what it means that Nancy is going to pay a higher premium compared to me because I have a shorter benefit period and Nancy has a longer benefit period. And again, apart from a shorter and longer benefit period, we are talking about a level of care. In your long-term contract, you're going to decide what actually you need. Is it to help you to put you to bed? Or is it to clean you up? Or is it to take you to store to buy something? All those you have to consider all of them in your contract. So the more benefit you derive, or the more level of care, if your level of care increases, your premium will increase. If you have a low level of care, you have a low policy premium. If you have a high level of care, you have a high policy premium. Also, longer elimination period is something you have to consider too. Who remembers what elimination period is? Can anybody help us in elimination period?
Okay, I'll try.
Try.
So it's a time of disability period to get benefits, like the payment period.
Yep. What elimination period always has a range, just like benefit period. It's payment, but however, there is a range, just like benefit period. From so time to so time. Benefit period is from so to time. Elimination period is from so time to so time. Anybody, any other person? Yeah, we have to know all this because you have to know them. We'll see them in the exam, definitely. So the elimination period, just like benefit period, the benefits period starts when elimination period ends. Let me say it again. The benefit period starts when elimination period ends. So what's then the elimination period? Elimination period is from the time let's assume you are on disability, or let's assume you are long-term care. You know, long-term care will trigger on when what? When you cannot be able to do 2 to 3 activities of daily living. That is the truth? Good. Now, the elimination period is that from the time you put on this claim, or the one is triggered on, till when you begin to receive the benefits. Let's assume the sickness start today. You're filing for your benefit. That day you file in for your benefit is not the day you start receiving it. Is that the same day? No. You may stay up to 2 to 3 weeks, up to 1 month, up to 2 months before you start receiving their benefits. So this period in which you are not receiving benefit, but you already, the sickness is already there and they already filed for the claim is what we call the elimination period. From the period in which, if it is disability, from the period the disabling occurs to when you start receiving the benefit caused by the disability is also called the elimination period. Is that clear? Any confusion, please? You should just know this on your own word. You can define them on your own word. Don't cram. Just know it and define it on your own word. So the elimination period stop, then the elimination period will start. So elimination period ends at the elimination period. Elimination period ends and benefit period starts. The end of elimination period is the beginning of a benefit period. Is that okay? All right. So let's go to underwriting. Of course, everybody have known what underwriters are and what the underwriting do. They consider so many things that relate to the underwriters. Of course, decide their premium. They decide their premium because when they have done all the fast checking they want to do, get all those together, it now determine what class they are going to place you. What is the risk classification that will be place you? That risk classification will now determine your premium. Remember, we have three risk classification. Who can remember the three risk classification? Anybody remember? The three risk classification. We have three of them.
Preferred, standard, and substandard.
And substandard. Yes, that is the three risk classification. These three risk classification are the determinant of your premium. They are not the same. If you are preferred, if you are classified as preferred, you are not going to pay the same premium with somebody who is classified as standard. If you are classified as standard, you're not going to pay the same premium with somebody who is classified substandard. So the risk classification you belong will determine what? Your premium. Most often, if you are preferred risk, you are going to pay what? I think 15% lower than the standard. Then if you are classified as a standard, you are paying the normal premium. If you are substandard, you are paying at least 65% more than what? More than the standard. So you can see the ranges. That the lowest you can pay is when you are classified as preferred. So that is the reason why we are bothering ourselves that, look, get your policy now, because tomorrow their risk classification can go from preferred to standard or from standard to substandard or even denial. So in insurance business, you got it when you don't need it. When you need it, you cannot get it. That's what insurance is. When you need it, got it. I mean, when you don't need it, got it that time. But when you think you need it, there must be an issue that make you not to be able to get it. So that's what insurance is. In case when you begin the real business, that's exactly the way you're gonna speak to your clients. Because most people claim, more especially our community, we claim we know it all, but honestly, we don't know nothing. we don't know nothing. For instance, when you're talking about 401k, 403b, and all those things, and Medicare and Social Security, because that's where our retirement is based on. Our hope today is based on what? Medicare and Social Security. And the things around Social Security, nobody knows. All I know is that my trust is on Social Security and Medicare. And when you begin to go into it, you get disappointed that they can't even save you. They can't save you. So when you're teaching, you have to at least know how to talk to them. Our people are so much educated, so it becomes difficult for a professor to listen to anybody. And that is the problem that is the main problem we are facing today. So the main difference here is that disability insurance focuses on individuals' ability to earn a living. Disability insurance focuses what? On an individual ability to earn a living. Remember, why do you have disability insurance? You have disability insurance to replace your income in case if you cannot able to get income through working, through being active to do your job and get income. If you cannot do that, disability insurance will now provide you income when you are disabled. But Long-term care, what does it do? It focuses on an individual's ability to live independently. You can see the two. You can be disabled, but still living independently. And you can be disabled and not being able to live independently. But which means long-term care now will take care of what? You not being able to live independently. And also in situation where you are totally disabled that you cannot be able to live independently. So disability insurance what? Help focus on individual ability to live, to earn a living, while what? Long-term care focuses on your ability to live independently. So this is the two ways to compare the two, disability insurance and long-term care insurance. So post-claim underwriting, another prohibited practice is the what? The act of approving all applicants and underwriting each risk exposure only when a claim is filed. This process results in insurer denying such claims based on what? Insured date or of other reason. This underwriting approach is considered an unfair trade practice and it is used as a prohibited with a long-term care policy. That was post-claim underwriting. Approving all applicants in each risk exposure only when a claim is filed. So that's post-claim. Somebody have already put a claim. Now you want to approve or to deny the person. That's what we call post-claim underwriting. And mostly in post-claim underwriting, they keep on denying people claim. Because if you do not do an underwriting, then the person now file claim. Let's assume somebody file claim, you just approve the person. You not do underwriting. Now, when the person now file claim, when the situation arises, the person file claim, you now begin the underwriting process. You now deny the person the policy. Because if you start underwriting process at that time, you're now going to find out the problem, existing health condition that the person was before the policy was put in. Because that's what we're going to discover. Pre-existing conditions, you have to find them before the policy was issued. Then why do you want to issue the policy without doing underwriting? Now, you want to do underwriting when the person problem has arisen, the person filed a claim, you want to do underwriting then. That's what's called post-claim underwriting. It's prohibited with long-term care policies. And you cannot do post-claim underwriting in life insurance. But here it's easy to do it in long-term care policies. So you're not supposed to do it. Is what? Prohibited. Association fidelity group, we're not going to do it. Employer group insurance. Of course, employer group insurance, everyone knows this one. Employer often offer long-term care as a voluntary employee paid benefit. This type of policy features simplified underwriting and discounted premium. So this one, they give it to their own executive. Tax consideration. Do we have tax deduction in underwriting? Let's see. So under HIPAA, of course, everybody knows HIPAA is long-term care plan, whether group or individual are classified as accident and health insurance for tax purposes. So if you have a long-term care, it's classified as accident and health insurance for tax purposes. This designation means that the premium paid by an employer under a group plan are tax deductible for the employer, but not counted as taxable employee compensation. In most cases, expenses for long-term care services, including premium for qualified plan, are treated like any other medical expense. Under the tax code, this treatment means that if such expenses exceed 7.5% of individual adjusted gross income, they are tax deductible. So is that a favorable tax plan for them for long-term care? It's tax deductible. Non-qualified long-term care insurance policies. What is a non-qualified account? Can somebody remember what is qualified and non-qualified accounts? Anybody remember? Qualified and non-qualified account. Can somebody remember what it is? Example of a qualified account and example of non-qualified account.
Qualified is 401k or 303. 403B.
That's qualified. Yeah, what of not qualified?
Non-qualified is money coming from
Okay.
bank or IRA.
All right. From what?
Rotary.
Count.
All right. So, of course, you got it. Qualified is 401k, 403b. They are qualified accounts. What it means that those accounts, you have not paid tax on them. So if anything happens, when you begin to withdraw your money, that's exactly what 401k is. And that's what we are trying to avoid. 401k and 403b or TSA, as case may be. Some people have either PSA or TSA. Some people has it. And 401k or 403b is a qualified account. You're not paid any tax on them. Though then when you want to withdraw money out of them, that is when you're going to pay a tax. And remember, is tax going to be high now or high in the future? Huh? That's a good question. Is it going to be lower now or high in the future? Which one? Anybody remember? Is tax going to be cheaper now or high in the future? Can anybody tell us?
I think maybe higher because of the inflation.
It may be correct. It may be not. It may be. It's going to be higher. Just let that word be really affirmed. It will be higher. Not maybe. It will be higher. Tax is going to be higher in the future compared to now. That is the basic truth. Was tax higher last year compared to this year? You see that this year is higher than comparing to last year. Those who have homes, what you are paying your home last year, is that what you are paying this year?
No.
All right, what happened?
It's higher.
Huh?
But 2/3 higher than.
It's higher. It's tax. So tax is going to be higher tomorrow compared to what it is today. So if tax is going to be higher today, and your qualified account, 401k, 403b, you're going to get them when you are 59.5, or from 59.5 upwards. That's when you withdraw without paying the penalty. Now you're going to pay the penalty, 10% penalty will be removed, and you pay your what? You pay your tax. Then, if you're going to pay a tax, then you know definitely you're going to pay more compared to what you're going to pay now. So you can see that 401k and 403b is preparing you to pay higher tax tomorrow. Now, if you decide to go to Roth, you want to pay a tax today. Then tomorrow or when you turn 59.5 years, you're not going to pay any tax again. You're only going to pay tax on the profit or the interest accumulated from your money. But in that of qualified account, 403 or 401k, you're going to pay what? Tax both on the account, but the principal itself and the interest. So why don't you at least have Roth? And you see what they do to Roths? The Roth have limits. You cannot put more than 8,000 when you are 50 years and above. You cannot put more than 8,000 in a Roth, which means they compel you to put your money in what? In 401k, because you cannot invest more than 8,000 in a Roth in a year if you are 50 years and above. If you are 50 years below, you are only allowed to put 7,000 in a Roth. So now you retire from your job. You still want to keep your money in a volatile account, 403b, where no matter what happens, you are still going to lose. Remember, you are no longer adding money to that. When you are working, you are adding. Even if you are losing, the impact may not be much because you are adding. Now you stop work, you are no longer funding the account. The account is just like that because no money is coming. It's only when you are working, they'll be adding money to your account. Now you are retired, no money is going into the account. You only be exposed to only losing because definitely the market may be bad. If the market is bad, you lose. When you are working, when you lose, you can add up. But now you are exposed You'll be losing and not adding. You only add when there is a gain. And does gain come often? Of course, no. So the impact you have in the money you think is going to help you to retire will be much. So that's why most often people will now say, in fact, let me run away from this losing. Let me roll that money in a place in which I'm no longer adding money on the account. Let me roll it over to annuity. You get it to fixed index annuity, it will stay there. You're not going to lose. Rather, you will gain. When the market is good, you gain. When the market is bad, you are not going to lose. So you are only going to participate in the gain and not participating in the loss. So that is good. That is the thing. You can see that even without somebody telling you that, you can see that it's clear. You see it happening. You know, you see it happening. So I think we're going to move ahead. Qualified long-term care insurance policies. Let's see, is there anything we're going to talk here? Tax exempted benefits. All right, let's just look at tax exempted one. All right, HIPAA established qualified long-term care insurance policy as specified category of insurance contracts, one that offers specific benefit and must meet specific requirement. The additional tax benefit for owning a qualified long-term care policy are the ability to deduct premiums and the ability to receive tax-exempt benefit in excess of actual long-term care costs. So, tax-deductible premiums, individual who owns a qualified long-term care insurance policy may deduct their premium if they itemize it. The deductible amount varies by age and changes annually. This one is going to give us something. Let's go ahead. Medicare, Medicaid, and long-term care insurance. Of course, everybody here knows what Medicare is, and everybody knows what Medicaid is. And of course, nobody will say he doesn't know what LTC, long-term care, is. That's what we have been dealing since. So now the following section offers a quick comparison of these three coverage types. All this thing is, three of this is what is expected of every retiree or every senior to have. Of course, you must have worked for at least 10 years or 40 quarters to be fully insured in Medicare. Of course, you can get Medicaid from your state. Medicaid is being funded by your state and the federal, and the state manages it. Medicare is funded by you because you contribute to it. It's an insurance, you contribute to it. Now, the long-term care is what you're going to buy to take care of yourself. So these are the three things required of every senior to have. You can see that this one, Medicare and Medicaid, is something required. You can get it. For the fact you have worked, you can get it. But does Medicare serve you all the purpose? Of course not. If you stay 20 years, 20 days, I think 20 days in the 60 days or 20 days in the hospital. 20 days, I think, in the hospital. After that days, any other day you stay, what happened? You're going to contribute to payment if you have Medicare. Medicaid, of course, Medicaid is state provision. They only go for the poorest of the poor. Those, if you go to Medicaid, you can't have Medicare and be receiving Medicaid. No. You can't have Medicare and be receiving Medicaid. You can receive Medicaid based on you have reached a particular low income, is for low income individual. Let me see. Medicaid is a means-tested public program that provides medical and supportive services to individuals or below the poverty level. So I think none of us want to belong to the poverty line. So the funding comes from both the federal government and state budget. Each state administers its own program. Medicaid services overlap with both Medicare and long-term care insurance. So low-income individuals age 65 and older can qualify for both Medicare and Medicaid to help cover their medical costs. Senior citizens who lack access can be eligible for long-term care services and support long-term services, which are paid by Medicaid. Now, It said, originally Medicaid paid for long-term services delivered in nursing homes. Given the increasing cost of such care, the federal government granted states the authority to devise alternative programs that could deliver these services along directive means such as in-home care. So you can see, it's for prepared, Medicaid is prepared for those who are on the poverty line. You don't want to belong to that line. You don't want to be feeding by federal government. In fact, I don't think any of us we go to the stop working and be relaxed and be saying, let the state feed me. I think it's not the right thing to do. I don't think our community are known by that. Because we are proud people. Our communities are proud people. Everyone wants to be independent, not to depend on government to provide those things for them. So now that somebody is working, why can't the person go and get a good long-term care insurance? Pay for it to take care of you when you grow old or when you are not able to take care of yourself. So the Medicare, of course, we know is funded by federal government. However, who fund it is you and me. The insured, the employee, the employers, and the what? Self-employed. They are the three people that fund Medicare and Social Security. So Medicare is a medical insurance in the traditional sense for individuals age 65 and older, as well as certain individuals with qualifying severe disability. It provides treatment for acute and chronic illness with long goal of curing acute condition and treating chronic diseases to mitigate their effects. So that's Medicare. Now, we have been talking about long-term care. We can no longer go through it. So as a senior, for you to live a good life, a real retirement, I'm talking even me too, for us to live a good life and a good retirement, we have to work at least. I will know. We have worked. We know we are qualified to get Medicare, but we don't know how long will that Medicare serve us. But if we are fully insured, our Medicare is there for us. Even when we die, we can pass it on to our beneficiary, which is quite correct. Now, Medicare have limitations. If you stay 20 days in the hospital, above 20 days in the hospital, you are going to contribute to paying it. And if you are taking blood, the first 3 pence of blood given to you, if you have Medicare, you are going to take care of it. Medicare will only come in after the first 3 pence of blood given to you. So you can see there's always a limitation. Now, if you have a Medicaid, of course, Medicaid will see that you are in the poverty line. You have crossed the poverty line. In fact, that is the final thing you can get. That is the final care you can get. If you have Medicaid, you have reached a situation that you can no longer be able to feed yourself. In fact, you can't even own a home that is on your name and be receiving Medicaid. I hope everybody knows that. Because they will tell you to go and sell it off and take care of yourself. Get a smaller apartment where you can be able to afford. So you getting those things will be, you see, it's just like bringing yourself down to nothing. Bringing yourself down to nothing. So you can't have a mansion, have a big car, have homes everywhere, and be talking about you getting Medicaid. No, you are not poor. And you cannot become, because you want to get them, you now make yourself poor. I don't think anybody wants that. So the plan we have as we will have for ourselves is today is what? As somebody senior or somebody who one day become a senior, the earlier the better we start to prepare it. Keep aside your Medicare and Medicaid. Your 401k and your 403b is a nice thing to have. You prepare your retirement based on your 401k and 403b. Prepare your retirement based on your long-term care. Prepare your retirement based on getting 1 or 2 annuity, and prepare yourself finally based on getting a policy, a life insurance policy. And believe you me, if you have all these 4 things, you're going to retire and you're going to live so wonderfully until the day the person will join his ancestors. That's the truth. If you have these 4 things, If you are, because if you now, let's assume you have only Medicare and Medicaid. The Medicare and Medicaid will only take care of you. They're not going to pay you cash. Then your Social Security have a limitation based on what your earnings now. How much you're earning now depends on how much benefit you'll be getting on your Social Security. And of course, the benefit period. Now, let's assume you have retired. You, in your Social Security, you're getting, let me be fair, $1,000 every month on your Social Security. If it is still there, because based on what is going on now, it may not be there. That's the truth. Of course, all of us know that Social Security is being funded not by government. Government don't put 1 cent into it. Social Security is being funded by you and me. The insured, I mean, the employee, the employer, and the self-employed. All of us know that. And you can see what's going on with the employee now. The employee number are being reduced every day based on the technology we have faced now. That's the truth. So if that continues to happen, then the funding in Social Security will be withdrawn. It's a basic truth. It's a basic truth. For instance, go to some of the grocery stores. You see that they no longer have a staff who check you out. You check yourself out. What does that tell you? Go to so many factories. They are no longer working with human beings. They work with machines. What does that tell you? And with time, technology evolving every day, in the next 10, 15 years, most of the job will be doing by what? Machines. And if that continues to go on, which I hope it continues to, not which I hope, which definitely, then Social Security benefit will be attacked. That is the truth. Because how do they pay benefit? Let me give you an example of how the Social Security benefit are being paid. Let's assume, all right, Mr. Kevin is here now. Mr. Kevin just passed the exam. Mr. Kevin, can you say hi to us? Mr. Kevin? Hello, Mr. Kevin? All right, I think he's not around, but I see him here. So let me tell you how to have Social Security. I mean, this Social Security that everybody, both me, everybody's hoping on. Let me describe how it's been done, how it's been, the benefit you get from Social Security. Let's assume Ms. Chiamaka, Hillary, and Ify are working. 3 of them are at work. They're working daily. Then Joseph Chukwuji has retired. Joseph has retired from his work. He's a retired now, he's no longer working. Now, Chiamaka, Hillary, and Ify are employees working differently on their own companies. They are paying 6.something% to Medicare, to Social Security. 3 of them are contributing, and Joseph is no longer working. So the contribution these 3 people made is all be used to pay Joseph for every month. Now, imagine where Ify is working. What happened to where Ify is working? Ify is no longer working because her work is being taken over by a machine, which means Ify no longer receiving her paycheck, because it's only through the paycheck that the Social Security will be funded. Now, which means Joseph now earning his benefit has been dropped because Hillary and Chiamaka cannot be able to pay, what they're paying cannot be able to pay Mr. Joseph monthly. So that's gradually how he sees it to evolving until at the point that the whole thing will no longer be possible. Now, what does President Trump do? Trump said, all right, from this year, that to show you, that is a sign that in future, it may not be there. That is the complete truth. What Trump said, all right, starting from January this year, that every child born in America, they will establish the government will open a $1,000 account for every child born from January 1st. And they have started doing it. Every child born first, government open an account, retirement account for that child. So that retirement account, they said the parents of that children have ability to deposit be funding the account. But the government has opened with $1,000 account for that baby. From the day that baby was born, from the hospital, they opened the account for the baby. So the parents of the baby will be funding the account. So what are they trying to do? They are trying to prepare that baby for retirement. So that will show you, by the time they start bringing all this alternative, will show you that Social Security with time will have problem. So we getting or preparing our retirement based on Social Security, yes, it's good, but how reliable it will be in the next 10, 15 years? Because government is not funding it, except government begin to fund it. Government never funds Social Security. Government never fund it. The fund of Social Security comes from me, the employee, the employer who employed us, and what? The self-employed. The same thing happens to Medicare too. So I think we're not gonna go through all this. We're gonna just listen to this video, we answer the question, then go to another chapter. This is 9 minutes video. So let's listen to it.
Great job completing the health insurance plans for seniors chapter. You've explored the detailed structure of Medicare, Medicare supplements, and long-term care insurance. Let's review the key concepts to reinforce your understanding. We began by exploring Medicare, the federal health insurance program established in 1965. Designed primarily for individuals aged 65 and older, Medicare also extends coverage to certain younger people with qualifying disabilities or end-stage renal disease. Understanding how Medicare works and who it serves is the foundation for navigating the broader world of senior health insurance options. Medicare is made up of 4 distinct parts, each designed to address a specific aspect of healthcare for seniors and certain individuals with disabilities. Medicare Part A, often referred to as hospital insurance, helps cover the costs of inpatient hospital stays, care in skilled nursing facilities, hospice services, and some types of home health care. This foundational coverage ensures that beneficiaries have access to essential medical services when they need hospitalization or specialized care during recovery. Medicare Part B is known as medical insurance. It helps cover the costs of outpatient care, including doctor's visits, preventive services, lab tests, and certain home health care. Part B also pays for durable medical equipment, such as wheelchairs and walkers, as well as some mental health services. Enrollment in Part B isn't automatic like Part A. It comes with a monthly premium. Medicare Part C, also called Medicare Advantage, is an alternative to original Medicare offered by private insurance companies approved by Medicare. These plans are required to provide at least the same coverage as Parts A and B, but often include additional benefits such as vision, dental, hearing, and wellness programs. Many Medicare Advantage plans also bundle prescription drug coverage and may have different rules, costs, and provider networks compared to original Medicare. Medicare Part D provides prescription drug coverage. It was created to help beneficiaries manage the cost of medications, which are not covered under Parts A or B. Part D plans are offered by private insurers and can be added to original Medicare. Each plan has its own formulary, a list of covered drugs, and may have different premiums, deductibles, and co-payments. Medicare Advantage participants cannot enroll in a separate Part D plan, as prescription drug coverage is typically bundled into Part C Medicare Advantage. We compared original Medicare and Medicare Advantage, highlighting key differences in administration, cost structure, provider choice, and coverage areas. Original Medicare is administered directly by the federal government and operates on a fee-for-service basis. This means beneficiaries can visit any doctor or hospital in the United States that accepts Medicare without being limited to a specific provider network. There are no network restrictions, giving enrollees broad flexibility and choice in their healthcare providers. In contrast, Medicare Advantage plans, also known as Medicare Part C, are offered by private insurance companies approved by Medicare. These plans typically require members to use a network of doctors and hospitals, similar to managed care plans. Medicare Advantage plans often include additional benefits not covered by original Medicare, such as vision, dental, and hearing services, and most also bundle prescription drug coverage. However, coverage, costs, and provider access can vary depending on the specific plan and insurer. This distinction between Original Medicare and Medicare Advantage is important, as it affects how beneficiaries access care, manage costs, and choose providers. As earlier mentioned, Medicare eligibility is primarily based on age and certain health conditions. Most individuals become eligible for Medicare when they turn 65 and qualify for Social Security or railroad retirement benefits. However, Medicare also extends coverage to younger individuals who have specific disabilities, such as those who have received Social Security Disability Insurance, SSDI, for at least 24 months, or those diagnosed with end-stage renal disease, ESRD, or amyotrophic lateral sclerosis, ALS. This broad eligibility ensures that millions of Americans, both seniors and certain younger individuals facing serious health challenges, have access to essential health care coverage through Medicare. Medicare enrollment periods are critical to understand. The initial enrollment period lasts 7 months, including the 3 months before and after one's birth month. Missing this period can result in penalties unless one qualifies for a special enrollment period. For example, imagine that John turned 65 in July. His initial enrollment period for Medicare begins in April, 3 months before his birthday, includes his birthday month of July, and ends in October, 3 months after. If John waits until November to enroll, he may face late enrollment penalties and a gap in coverage, unless he qualifies for a special enrollment period due to circumstances like losing employer coverage. Medicare claims are processed by Medicare administrative contractors on a fee-for-service basis. Participating providers accept Medicare's approved amount as payment in full, while non-participating providers may charge up to 15% more. It's important to understand the difference between Medicare Parts and Medicare plans. Parts refer to the sections of the federal Medicare program. Part A, hospital insurance. Part B, medical insurance. Part C, Medicare Advantage. Part D, prescription drug coverage. Plans refer to Medicare supplement insurance, also known as Medigap, which are policies sold by private insurers to fill coverage gaps in Original Medicare. These standardized plans are labeled A through N and cover various combinations of deductibles, coinsurance, and additional benefits. Read exam questions carefully. Some may ask you to distinguish between parts and plans. Plan A offers core benefits that all Medigap plans must include, such as Part A coinsurance, Part B coinsurance, blood coverage, and hospice care coinsurance. Other plans offer additional benefits like covering other deductibles, copays, foreign travel emergencies, and Part B excess charges. Next, you looked at long-term care insurance, which pays for a broad range of medical and personal services for individuals who need assistance with activities of daily living for an extended period. There are 3 primary levels of long-term care, each designed to meet different needs. Skilled nursing care is the highest level, provided by licensed medical professionals such as registered nurses and therapists. This care typically involves complex medical treatments, rehabilitation, or monitoring that can only be performed in a medical facility, or in some cases at home under strict supervision. Intermediate care is a step down, offering regular but less intensive medical and rehabilitative services. It's often provided for individuals who need ongoing assistance, but not the round-the-clock skilled attention required in a hospital setting. Custodial care focuses on non-medical support, helping individuals with activities of daily living like bathing, dressing, eating, and mobility. This type of care does not require medical training and is often provided by caregivers or aides. These services can be delivered in a variety of settings, including nursing homes, assisted living facilities, adult daycare centers, or even in the comfort of the individual's own home. The flexibility in care settings allows individuals and their families to choose the environment that best meets their needs and preferences as their health circumstances change. Long-term care insurance benefits are triggered by either the inability to perform 2 or more activities of daily living or a cognitive impairment. Policies typically pay benefits as a daily maximum amount for a specified benefit period. Finally, we examined how Medicare, Medicaid, and long-term care insurance work together. Medicare provides medical insurance for acute care, Medicaid offers means-tested coverage for low-income individuals, and long-term care insurance fills the gap for extended care needs. Understanding these various senior health insurance options is essential for helping clients navigate this intricate system and make informed decisions about their healthcare coverage. Keep reviewing these concepts, especially the distinctions between different Medicare parts, long-term care benefits, and benefit triggers. Remember that the exam will test your ability to identify eligibility requirements, enrollment periods, and coverage details. Keep up the good work! Before moving on to the next chapter, take a moment to review key concepts and complete the practice exams to test your understanding. A solid grasp of these topics will help you confidently pass the exam.
All right, so that is it. We are done with this, which means we are done with chapter. We are done with chapter 70. What happened? Come on. All right, we are done with chapter 17. So let's just firstly go through the exam. Then chapter 18 is health insurance policy provisions. It's a very sweet chapter. We're going to deal with it in the evening, and where we'll be able to know the provisions that guiding the policy. In fact, without provisions and clauses, life insurance, the insurance company will be riding on everybody. That's the truth. But because of the clauses and provisions that are attached to life insurance, which is provided by National Association of Insurance Corporation, if not the provisions and clauses, then remember the contract of insurance is a contract of adhesion where one person wrote the contract, the insurance company wrote the contract, then you and me now made an offer to the insurance company for the policy. Then if without the clauses and provisions that are attached to the policies, to the contract, it'd be difficult for you to have some essential benefits. So the clauses are there, the provisions are there. We're going to look at the provisions that helps us, some of the provisions that are in our benefit, and some clauses that are in the benefit of the insurance company, and provisions that are benefit to the insured. We're going to see it in the evening. That is chapter 18. So let's go through this exam. How many is about? It's just few questions. Few questions. All right. It's only 7 questions. So this one is only 7 questions. Let's do it. Remember, use elimination methods to answer the questions. In fact, if you read through Excel solution, what they tell us on how we're going to answer questions, you see that they opted to advise you to use elimination method. So for those who have this, who have Excel solution, I advise everybody to have it. If you have it, just on your own practice, personal practice, go through it and see what they tell you on how to answer questions. All right, this one says, if a retiree on Medicare required 5 hospital stay in 1 year, which policy will provide the best insurance for excess hospital expenses? Excess hospital expenses. Which of the policy will give you that? If a retiree on Medicare required 5 hospital stay in 1 year, which policy will provide the best insurance for excess hospital expenses?
B.
Any other person? Somebody say B. Any other person? Any other person?
B.
All right.
C. Medicare supplement. B.
All right, it's B. Look at it. Told you that if a retiree on Medicare, the person is already on Medicare, then for excess hospital stay is Medicare supplement. Remember what Medicare supplement is? Who remember what Medicare supplement is?
For rich people.
Anybody remember what Medicare supplement is? Medicare supplement.
They pay whatever the Medicare did not pay. Or start where they stop.
They cover where what Medicare Part A and Part B cannot cover. Yeah, and what are they? They are on Part C. Medicare supplement is Part C. Remember, they come into play where Medicare Part A, Part B cannot cover. So this person is already on Medicare, and he has required 5 hospital stays in 1 year. They ask you which policy can best provide the best insurance for that excess hospital expenses is Medicare supplement. I say the individual most likely to buy a Medicare supplement policy will be who? Who is most likely to buy Medicare supplement?
C.
Any other person?
No, it's B. 68-year-old male covered by Medicare.
All right. So any other person?
B. C.
I think two people say B, or three people say B.
B.
C. I say C.
No, it's B. You see one thing here. Who can buy Medicare supplement? It's the person who has Medicare. Person who has Medicare cannot go buy Medicare. Medicare supplement, Medicare go with Medicare supplements. Because supplement comes when Medicare ends, when Medicare fails. That's services that Medicare cannot give. That's where Medicare supplement will give. So in this kind of a question, you have seen, it said the individual most likely to buy a Medicare supplements policy would be what? Somebody who have already Medicare, which is 68 years old, what? Covered by Medicare. Because you cannot have Medicare to go and buy Medicare supplements. So there's no way you can have Medicare. You can't go buy Medicare supplement. And for you, the person that is unemployed, 64-year-old female who is unemployed, how can you be unemployed? If you're not employed, do you have Medicare? Except you have worked before. For uninsured 60-year-old male, of course, this person is not even is uninsured. Remember, for you to be uninsured to have Medicare, you must have an sickness that have led them to give you that. If not, you not receive that. It's for old adults and what? And children, younger ones who are disabled. The younger one, for this person who is 60 years, is not young. And is not up to the old age of 65 years to be able to receive Medicare. So he has to be in a condition where Medicare can come in. So D is totally out. C is not there, it's Medicare. Medicare is not Medicare and not the same. The guarantee of insurability option provides a long-term care policy owner the ability to do what? Remember what guarantee of insurability option is? Provide a long-term care policy owner the ability to do what? What does it do? At least two of the options is totally out. You don't remove two of the options. I would say three, but two, don't remove two. There's two that you're not even supposed to look at. Two. You're not supposed to look at them at all.
I'll say C.
Right. Any other person? Any other person? Somebody says C. Say any other person. Any other person? Oh, if nobody says something, then we're gonna follow her.
C.
Right.
Buy additional coverage
Right.
at a later
Right.
date.
Of course, that's what guaranteed insurability option is. Remember when I said it? Guaranteed insurability option is for to buy additional coverage at later dates without evidence of insurability. They will not ask you for evidence of insurability. It's a rider. That rider, you have to have it. If you don't have it, you cannot get it. So you have the rider, you are allowed to buy more policy at later days without evidence of insurability. Remember what I said? The insurance company can reduce your first amount, but cannot increase it. They cannot add it. So with insurability option rider, you can do what? Buy more policy at later date without evidence of insurability. So this one, qualified long-term care policies may take into consideration an applicant's pre-existing condition for a maximum of not more than more than what? Months prior to effective date of coverage. Pre-existing condition, how many months? We'll talk about it. How many months can they consider pre-existing condition? How many months?
1 day.
How many months they consider it?
One long-term care policies may take into qualified long-term care policies may take into consideration the applicant's pre-existing condition for a maximum of not more than the effective date of coverage.
6 months.
Yep. Somebody says 6 months. We have been hammering in 6 months. You don't need to. Pre-existing condition, look back is 6 months. They cannot look beyond 6 months. Of course, that's one of the things Obamacare did that's so good. That's why most people have policy then. ACA, you cannot look beyond 6 months. Yeah. The pre-existing condition must be from 6 months, from the time you're looking to back 6 months, cannot go below that. If you put more than 6 months, I'm telling you, most people are not going to qualify to have a health policy. And that's why before that, a lot of people do not have health care coverage. So long-term care policies will usually pay for eligible benefits using which of the following methods.
The policy will usually pay for eligible benefits using the following methods. Okay.
B.
All right, somebody said B. We're going to follow her because we don't have time. Expense, fee for service, expense incurred. They pay what you cured, not long-term care policy will surely pay for eligible benefits using which of the following. They pay what expenses you cured. They don't pay. Who pay fee for services? Who remember? Who pay fee for services? Who pay fee for services? Who pay per person?
POP.
Huh?
PPO.
Oh, PPO.
Medicare pay. HMO pay per person. Per person. Then Medicare pay fee for services. I hope you remember. HMO, PPO pay per person. Then if you come to HMO is from Part C, which is Medicare, Medicare Advantage. We did all this yesterday.
Okay.
That's why I say sometimes some of these things, write them down. That will help you. Yeah. Nobody's brain is computer. It's some of these points, just write them in a small note. When you come to this way, just when we are discussing like this, just go through it. That will come up to your mind immediately. But if you just based on listening, honestly, it's difficult. It's difficult. So always write something down. That will help you when you want to check. At the time you want to go through your readings, that will help you. Mr. Kevin, can you talk to us, Mr. Kevin?
Yeah.
Oh, Kevin. All right. So Kevin passed his exam yesterday. It was a good thing hearing it. Kevin, say hi to us. Tell us what happened. What did happen? What did you see and what did you not see?
Virtually everything you taught us appeared.
Wow. Congratulations, Kelvin.
Thank you. Everything, virtually everything. But I use the elimination method.
Use the elimination
method. Taught us. I used as soon as I finished the national one, I went into the state. The state was a little difficult, but I thank God I read it.
All right. But you can see that the state has a straightforward answer, but you have to know it.
Yeah, if you have not read it, you will not know it.
All right, so that is it. So that's what I'm saying. The state always, if the state section is something you have to read. In this, you have more scenario question in the national one. Scenario question, you have a lot of scenario questions in the national one. Yeah, congratulations. That's one. So
Thank you.
What you're gonna do now is to join the reteaching. When your license is verified.
I joined yesterday.
You joined yesterday, see?
Yeah, I saw people making millions. The man from Cameroon who led it made, I think it's on 9 or 10 million.
So you're gonna begin now to join the reteaching. Definitely. We're gonna remove your name from this platform. We're gonna put you to the other side. You're no longer on this side. So you're welcome. Congratulations.
Thank you.
That's a good thing. Congratulations.
Thank you.
Hi, engineer. Good morning.
Good morning.
This is Ife. I have not been able to log in because I was so drained after my exam. I missed it by 1.
Oh my God!
Oh God.
1.
The first part was okay. You know, as soon as I started, I said, oh my goodness, everything looks fine. Everything you said. I mean, at the time I was asking myself, am I picking the right answer? Why is this so easy? Then until I get to the Texas or whatever, one. I can't even spell my name there. I was just guessing and just 2 things. Even the CEU, I couldn't even remember if it's 20 or 24. Oh my goodness. Everything they were asking there, I was just guessing. That's where I said, what? This just messed up my day.
Oh my God, 1 point. You see,
1 point.
Did you go back to change answer? Did you change answer?
I think about 2 or 3.
Oh no.
That's where I made a mistake.
No.
2 or 3, because I wasn't sure. I was just going back and forth. I have plenty time.
I refuse to change answers.
I refuse to change answer.
Oh my God.
Because if you change answers, you'll be answering the wrong one.
So anyway, what you're gonna do, you write it yesterday, today is Friday, by Saturday, register again.
Go back.
I will.
Don't waste time on registering.
Please,
waste time, the ones you know will vanish.
Answer, leave
so
it.
when are we gonna do the one for the state? Or have we done it?
No, we have not done it. What I normally do on that of the states, because all of us come from different states. You know. So if I begin to do one state for another, what it means that doing 50 states is become difficult.
No, I don't think the way the questions was, it was only one question that says, okay, there was one question that says domestic insurance. I said, Lord, what is this one again?
Domestic insurance, we said it now.
License.
We discuss it.
We have discussed it here.
I don't think I have come that time.
Oh my God.
It's not a bonus question, bonus free question.
It's a bonus question to you.
To you, because you know it, you have had it before. So
go get your notebook and sit up, you write down.
You see, that's why when we're here, honestly, that's why even what Dr. Ruth said that everybody should be on video. That's what she said. And if you look at it, it's good. Because when you're on video, you are paying attention, you are on your table. These 2 hours we are staying, you bring out these 2 hours as 2 hours of purpose. You carry a pen, have a small paper where you'll be jotting up things down. If you do it that way, definitely you're not going to miss anything. But if you are only listening, you listen. It does not work that way. Lie. It does not work. Because, all right, imagine somebody who went to school, maybe a child who's in school, he doesn't have a note. He just any day he listen. Is your brain computer? Even if it's computer. And judge based on what we have. All of us here have issues. That's work and family, this and that that's bothering us. So this is not our intended thing to do, but this is a desire from our heart. I want to get this accomplished to refocus our finances. That is the more reason why all of us are here. So, being that, you have to get a pen, get a paper. Anytime you are doing it, that 2 hours.
I have plenty
more especially
notes.
when you are at home, focus. Be on video. Say your children that you're in a class, nobody should disturb you in these 2 hours. Just stay and focus. Now, whenever I'm saying something, I say, please this thing is you may likely see it in the exam. Please, can you write it down? Whenever I say so, just write it down, write the meaning. Then you see all those period. There are a lot of them, and they are confusing. I know that. So write them down. Now, for the issue, some people did not follow us to start from chapter 1. Agreed. Then, like now we're finishing. My plan is to, if we finish chapter 18 today, then my plan is by Monday at least, we start from chapter 1 again. So for those who have not followed us from chapter 1, we now follow. But
Okay, thank you, sir.
most times, people have to read by their own, read by yourself, and do practice questions. For the state part of the questions, exam, it starts 5 questions. The truth of the matter is this. No matter, if you like, get the national 100 over 100 without you getting, doing the state, you're going to fail. And the state, because remember what she just said, one of the questions they asked her, if you are practicing in the state in which you are located, it's called what? What is it called? If you are practicing in the state you are located, let's
That is
assume
a domestic insurance.
domestic insurance. That is, for instance, somebody living in Texas and practicing in Texas, you have Texas license, you are domestic insurer. Then if you are living in Texas and you are practicing in Virginia or Florida, what is it called? What is it called?
Foreign.
Huh?
Foreign.
All right, foreign. Now, when you are practicing in when you are in America and you are practicing in Mexico, what is it called?
Online.
Good. So this is 3 things. This 3 of them. So that's why somebody says it's a bonus question. It's completely a bonus question. It's a completely bonus question. So now that you have tried it, you have seen how it is. The next one definitely going to pass. Focus by, you wrote it yesterday, by tomorrow. How I wish you just pass as Kevin passed. It would have been so good. It would have been so good. Could be 2 people.
You make it.
Yesterday, but you're still going to make it. So just keep on attending the class and start reading on your own. And the states, it's difficult for me to do all the states. But if I have the time, what I normally do, I have done it once or twice, is I say, all right, people from one state, we can do so time. But most times it's difficult for me even to bring out time for that. So state part, you can read it on your own. Ask questions. If you come here, just ask questions. We can discuss it together. If I have the time, I can say those people from Texas, those people from social place. But if I continue to do it that way, it's gonna be so difficult, so hard to fulfill. So that's why I leave.
I've known about domestic insurance. What about the foreign? Say that again.
The foreign is when you are in Texas and you have license in Texas, you are practicing in Florida, any part of the state.
Okay.
Yeah.
Then one of New Mexico.
The island is when you're country to country.
Okay.
Yeah.
Well, state to state, then country to country. Okay.
Yes. So I think we did it on chapter 1. Maybe when we go back on chapter 1 on Monday.
Yeah. Excuse me. Okay, you said Monday, sir. That's my question.
You said?
No, I said you just answered my question. I wanted to ask, when are you going to start? Because it's like I'm ahead of myself.
No, it's good to be ahead of yourself.
Yes, like all these things that the answer that I was answering before, it was the class. I had not even read that place, those chapters.
Yeah, we're gonna start. Remember, we will enter chapter 18 this evening, and probably we're gonna finish chapter 18 this evening. Then by tomorrow Saturday, we now do chapter 19. If you could not finish chapter 19 tomorrow, because chapter 19 is big, If you could not finish it tomorrow, then we finish it in the morning. Then evening, Monday, we start chapter 1. So definitely we may start chapter 1 on Monday. That one is sure. We're going to start chapter 1 on Monday. So, however, I would have prefer when we finish, we go and do this question. I would prefer when we finish, we go back and do all these questions. That will give us a leeway all these questions, simulation question, pre-exam, exam 1 and all those, we do simulation exam. Then we now start chapter 1. That would have been better. So that we do the question that will help us. Then before we now go to course introduction, life insurance and health pre-licensing introduction. Basically, we may start it on Monday, and that will help some people. So that is it. Everybody should read there call it, reset your mind and make it that, oh, I want to do this, I want to get this exam passed. This exam is easy. If you follow what we are doing here and you are putting your own effort by, when you get time, you do the exam, you do the questions, read on your own. Give it 1 week, you get it done, honestly, to tell you the truth. The only problem is that we may not finish all the chapters within 1 week, but if we said this 1 week, I mean, we take 2 weeks to finish up the chapter. Within that 2 weeks, we plan to write this exam. So that's all. It's not difficult. It's not difficult. Just any 2 hours you are here, be so attentive and jot down things and ask questions and contribute. Remember, I said nobody's teaching anybody here. I'm not a teacher. I'm just a moderator. We are trying to make it look easy for all of us to go there and write and pass. That's basically what we're doing. So, Mr. Kevin, congratulations, and the other person that tried, go again, re-register your exam. Is they give you, I think, 48 hours to re-register. If you do not make it, be proud to say you do not make it. Then look at, all right, look, if they give you a printout, go through that printout, you see your performance. If you go to the printout, you see when you write, if you write the number, like as you miss 1 point, they give you a printout. Look at the printout, you see your performance there. Look at those areas that have a shorter line. That's the area you're going to concentrate more. Yeah. The area that have a shorter line, they draw line. Area that have a shorter line, you're going to put more effort on those areas to bring yourself back, up a little bit so that you can get it the next time. All right. So if there's no question, nobody has any question, I would say we're going to see in the evening, hopefully by the evening, by 6 p.m., we'll see by 6 p.m. All right. So good day, everybody.